Hello students, myself is Parminder Singh from Prab Kirpa classes. In the earlier course, we had discussed what is the difference between services and goods, what is the meaning of banking, what are the various types of banks, what are the various functions which are performed by commercial banks, what are the bank accounts which are offered by the commercial banks, and we had also understood the terms like demand draft, overdraft, discounting of bills, and cash credit. We had also understood the concept of e-banking in detail. Now, in today's course, we will concentrate on the topic insurance principles and types. In this course, we will discuss what is the meaning of insurance, what are the 7 basic principles of insurance. Insurance contract is a contract of prima fide explain. We will also understand what are the various functions of insurance and what are the various types of insurance. What is the meaning of life insurance? What are the main elements of a life insurance contract? Life insurance is not a contract of indemnity. Discuss whether insurance in insurable interest in case of life insurance must be present both at the inception and maturity of the policy. Discuss and what are the various types of life insurance policy. We often wonder why we need insurance when we are young, healthy, have multiple sources of income. But we must understand that life is full of uncertainties. The chances of occurrence of an event causing losses are quite uncertain. There are risks of accidental death and disability for human life, fire and burglary risk for property, perils of sea for shipment of goods, and so on. If any of these take place, the individual or organizations may suffer a great loss. It is to minimize the impact of such uncertainties that there is a need for insurance. Now we will understand the meaning of insurance. The emotional and psychological loss can never be compensated, but at least the financial loss can be compensated with insurance. An entity which provides insurance is known as an insurance or an insurance company, while a person or entity covered under the policy is called an insured. Insurance is a form of risk arrangement. Insurance is a legal contract between two parties, the insurance company and the individual that is insured, wherein the insurance company promises to compensate the insured for financial losses due to specific contingencies or perils. And the amount the insured pays for this arrangement is called premium. The contract or agreement is put in writing and is known as policy. Now we will understand the importance or need of insurance. We can understand the importance or need of insurance with the help of an example. Nikhil bought a car of rupees 10 lakhs. He purchased car insurance covering third party insurance plus own damage. He also bought medical insurance, while his friend Ravi bought a car of rupees 11 lakhs. He purchased a third party insurance because third party is compulsory in India. Ravi thought that purchasing any other insurance is a waste of money. After 6 months, due to unforeseen circumstances, Nikhil and Ravi met with an accident. Nikhil got a claim for his car damage as well as a claim for his hospitalization expenses. On the other hand, Ravi was having third party insurance only. So he paid the car repair expenses as well as hospital expenses from his own pocket. Here we may clarify that third party insurance means that whenever an accident occurs, the damage or loss or injuries suffered by the other person are payable, and any damage or injuries suffered by the person insured himself are not covered at all. There are many people like Ravi who think purchasing insurance is a waste of money. It is a very important to have some specific insurance products in life. Insurance acts as a financial backup at the time of emergency. Insurance helps in securing future. Insurance gives us peace of mind. Now we are to touch an important topic on insurance, that is seven principles of insurance. First is principle of utmost good faith. Second is principle of insurable interest. Third is principle of indemnity. Fourth is principle of proximate cause. Fifth is principle of subrogation. Sixth is principle of contribution. And seventh is principle of loss minimization. We will discuss each of these principles one by one in detail. There are seven basic principles of insurance which are as under. First is utmost good faith. Insurance contract is a contract of ubrime fide. That is a contract based on utmost good faith. It means that the standard of honesty required in insurance contracts is greater than that is usually required in most ordinary commercial contracts. According to the principle of utmost good faith, the insured must disclose all material facts regarding the subject matter of insurance to the insurance company truthfully, as the insurance company does not know anything about the subject matter of insurance. On the other hand, the insurer must provide to the insurer complete, correct, and clear information regarding the terms and conditions of the contract. The principle of utmost good faith is applicable to all contracts of insurance, that is, life, fire, marine, and other general insurances. When breach of utmost good faith occurs, the aggrieved party has the right to avoid the contract. Now we will understand the meaning of material fact. A material fact under the insurance contract means any situation, information, or fact which affect the decision of the insurer whether to accept or decline the proposal or charge an extra premium to accept the proposal extra. Examples of material facts in insurance are: in the case of building insurance, the material fact may be a part of the building is being used to store flammable materials. In the case of life insurance, example of material fact is age, previous medical history, and smoking or drinking habits of the insured person. Next principle is the principle of insurable interest. The insured must have an insurable interest in the subject matter of insurance. Insurable interest acts as a qualifying criteria for granting insurance. A person has an insurable interest in something when loss of or damage to that thing would cause the person to suffer a financial or other kind of loss. Normally, insurable interest is established by ownership, possession, or direct relationship. For example, a person has insurable interest in his own home and vehicles, but not in his neighbor's homes and vehicles. A company may have an insurable interest in the chief executive officer or other employee with special knowledge and skills. A creditor has an insurable interest in the life of a debtor up to the amount of the loan. A married person has an insurable interest in the life of his spouse. Third principle is principle of indemnity. This principle is applicable to fire, marine, and other general insurance. The principle of indemnity in insurance implies that in the event of loss, the insurer shall put the insured in the same financial position that he occupied immediately before the loss. Principle of indemnity means protection or security up to the amount of loss or insurance cover whichever is lower. For example, a person gets his stock insured for 5 lakhs. There is a fire in the shop. The insurance surveyor assesses loss to the tune of rupees 1 lakh. In such case, the insurance company pays rupees 1 lakh and not rupees 5 lakhs. The compensation amount is directly linked with the amount of loss incurred. The principle of indemnity is not applicable to life insurance and personal accident insurance because the value of human life cannot be measured in terms of money. Next principle is principle of proximate cause. According to this principle, when the loss is the result of two or more causes, the proximate cause, that is the direct, the most dominant, and the most effective cause of loss should be taken into consideration. The insurance company is not liable for remote cause. For example, Mr. Joseph has taken a fire insurance policy for his shop. Let us assume that his shop caught fire and Mr. Joseph filed a claim with the insurance company. Upon investigation, the insurance company found that the proximate cause of the fire was a minor earthquake in that area, which led to the collapsing of the shop ceiling upon the electric meter, which then caused the fire. Under the terms and conditions of the fire insurance policy, earthquake, which is an act of God peril, is not covered, and the earthquake being the proximate cause of loss, Mr. Joseph's claim was rejected. Here we will understand the meaning of act of God perils. Act of God perils means natural calamities like storm, tempest, earthquake, and floods, which are inevitable and affect the large area and population, and these calamities are not in the control of the human beings. Next principle is principle of subrogation. This principle comes into play when a loss has occurred due to some other person or party and not the insured. According to the principle of subrogation, after the settlement of the claim, the insurer shall be entitled to take over the legal rights of the insured against the liable third party for recovery. We will understand this principle with the help of an example. For example, air conditioner fire due to mechanical problem caused a lot of damage to your home. fire is covered in your householder policy and the insurance company pays you for the loss suffered by you as per policy conditions. As the faulty wiring by the AC manufacturer caused the loss, the AC manufacturer is ultimately responsible for your damages. After the payment of the insurance claim, your right against the AC manufacturer is transferred to insurer and the insurer can recover the claim amount from the AC manufacturer. This is known as subrogation. Next principle is principle of contribution. This principle of contribution applies when the insured has taken more than one insurance policy for one and the same property. It means that you may be having only one vehicle and you have arranged insurance for the same. At the same time, your bank has also arranged for the insurance of your vehicle. So there are two insurance in force for the same vehicle. According to the principle of contribution, if you have taken insurance from more than one insurer, then all the insurers will contribute the amount of loss in proportion of their respective coverage. The insured cannot say that each insurer should separately pay the full loss because the insured has no right to recover more than the full amount of his actual loss. If the full loss is paid by one insurer, then the insurer who has paid the claim has the right to call upon other liable insurers to pay their share of loss. We can understand this principle with the help of an example. A person got his factory insured against fire for rupees 5 lakh with insurer A and with another insurer B for rupees 10 lakhs. There was a fire and loss was to the tune of rupees 3 lakhs. Then insurers will contribute the loss in the ratio of 5, 10 or 1 is to 2 and will be liable to pay rupees 1 lakh and 2 lakhs respectively to the insured person. That is in the case of insurance company A, sum insured was 5 lakhs. In the case of B insurance company, the sum insured was 10 lakhs. Loss is total rupees 3 lakhs. So when we are to calculate, so the total is sum insured in the case of A plus B is 15 lakhs. So we can say that out of 15 lakhs, the loss is rupees 3 lakhs. So we will have to calculate accordingly. That is, against 15 lakhs, there is loss of rupees 3 lakhs. So when the sum insured is 5 lakhs, one lakh, and then here it will be 3 lakhs divided by 15 lakhs into 10 lakhs. So you can understand that the insurance company A will be liable to pay rupees 1 lakh and the other will be liable to pay rupees 2 lakhs. Now comes the principle of loss minimization. This principle states that it is the duty of the insured to take all reasonable steps to minimize the loss to the insured property on the happening of uncertain event. Suppose goods kept in a storehouse catch fire. Then the owner of the goods should try to recover the goods and save them from fire to minimize the loss or damage. The insured must behave with great prudence and should act as if he is uninsured. The owner should have called the nearest fire department office or and using fire extinguishers extra. We may add that we have already uploaded courses on email writing, present tense, future tense, past tense, cybersecurity, letter writing, most common mistakes in English grammar, business studies, BBMS, information technology, web applications, and much more. You can look for the same on YouTube, Google, our own website, Udemy, Tutorials Point, and other websites. Now we understand the functions of insurance. The functions of insurance are certainty of payment, protection, sharing of risk, promotes economic development, and improves the efficiency. Now we will understand each of this function one by one. The various functions of insurance are as follows. First is certainty of payment. Insurance companies provide certainty of payment in the event of a loss from specified perils. Time of occurrence of loss and the amount of loss both are unpredictable. The insurer charges the premium and assures the payment on the happening of insured risks. Second function is protection. The second main function of insurance is to provide protection against possibility of loss. Insurance company cannot stop the happening of a risk or event, but can compensate the insured person for losses resulting from the risk. Third function is sharing of risk. People purchase insurance and in lieu thereof pay premium to the insurance company. On the happening of a risk event, the loss suffered by any of the insured is paid out of the premium amount paid by these policyholders to the insurance company, and thus risk is shared by many persons. Fourth function of insurance is it promotes economic development. The insurance companies accumulate a lot of funds by way of premium payments. The insurer invests these accumulated funds in the shares of various companies and other investment avenues for earning profit. This leads to economic development of the country. For example, Life Insurance Corporation of India owns stocks, that is shares of different companies worth rupees 9.5 lakh crore. Fifth function is insurance improves the efficiency. As the insurance provides guarantee for compensation in the event of mishap, it relieves the businessman of worries and tension of risk. This leads to better productivity and improvement in efficiency of the organization. Insurance can be broadly classified into two types, life insurance and general insurance. Again, the general insurance can be classified into three types, fire insurance, marine insurance, and other insurance. Examples of other insurance are vehicle insurance, health insurance, burglary insurance, cattle insurance, crop insurance, sports insurance, अमर्त्य शिक्षा योजना, राजेश्वरी महिला कल्याण बीमा योजना. This list of other insurance is only for illustration. There are many other insurances like shopkeeper insurance, householder insurance, electronic equipment insurance, professional indemnity insurance. The list is very large one. This is only for illustration purpose. Now we will discuss life insurance. Life insurance is a contract between an insurance policy holder and an insurer, where the insurer promises to pay a designated beneficiary a certain sum of money upon the death of an insured person, often the policyholder, or on expiry of certain period. The policyholder pays premium in lump sum or periodically, that is monthly, quarterly, half yearly, or yearly. The agreement or contract which contains all the terms and conditions of the insurance is put in writing, and such document is called the policy. The person responsible for making premium payments for a policy is the policy owner, while the person whose life is insured is called insured. The owner and insured may or may not be the same person. For example, if Joy buys a policy on his own name, he is both the owner and the insured. But if his wife Lena buys a policy on Joy's life, she is the policy owner and Joy is the insured. The insurance company is called the insurer, and the consideration paid by the policy owner or insured is called premium. In cases where the policy owner is not the insured, the insurance companies restrict the policy purchases to those with an insurable interest in the insured. For life insurance policies, close family members and business partners will usually be found to have an insurable interest. If the principle of insurable interest is not applied in life insurance, the risk that a purchase that a purchaser would murder the insured for insurance proceeds would be great. In at least one case, an insurance company which sold a policy to a purchaser with no insurable interest, who later murdered the insured for the proceeds, was found liable in the court for contributing to the wrongful death of the victim. This is here has been given, it is the judgment which was passed by the court. Importance or benefits of life insurance. Life insurance provides protection to the family at the premature death of an individual. Life insurance is a sort of investment because a certain sum is returnable to the designated beneficiary on the death of life insured or at the expiry of a certain period. Life insurance encourages savings as the premium has to be paid regularly. Common exclusions include claims relating to suicide, fraud, war, riot, and civil commotion. The policy becomes null and void if the insured dies by suicide within a specified time after the purchase of insurance. Usually, 1 or 2 years suicide clause is there in life insurance policy. Now we will understand the main elements of a life insurance contract. These are as under. The life insurance contract must have all the essentials of a valid contract. Certain elements like offer and acceptance, free consent, capacity to enter into a contract, lawful consideration, and lawful object must be present for the contract to be valid. Second is the contract of life insurance is a contract based on utmost good faith. The assured should be honest and truthful in giving information to the insurance company. He must disclose all material facts about his health to the insurer. It is his duty to disclose accurately all material facts known to him, even if the insurer does not ask him. In life insurance, the insured must have insurable interest in the life assured. Without insurable interest, the contract of insurance is void. In the case of life insurance, insurable interest must be present at the time when the insurance is affected or taken. It is not necessary that the assured should have insurable interest at the time of maturity also. Suppose a wife took a life insurance policy on the life of his husband. After 1 year, the couple got divorced, and later on, the husband dies 2 years after divorce. If the ex-wife is continuously making payment of the premium even after divorce, she can still collect the death benefit from insurance company even when she no longer has an insurable interest in her ex-husband, unless the divorce settlement does not include any provisions that might change this. The insurable interest must be present at the time of taking of life insurance policy. Some other examples of insurable interest in the case of life insurance are as under. A person has insurable interest in his or her own life and also in the life of his or her spouse. A creditor has an insurable interest in the life of his debtor, and an employer has an insurable interest in the lives of his employees. Fire and marine insurance contracts are contracts of indemnity. That is, they provide compensation to the insured for loss or damage sustained. In the case of vehicle insurance, if the car is damaged, the insurance company will get the vehicle repaired or replaced. But in the case of life insurance, is it possible for the insurance company to bring the person back to life? Not at all. Principle of indemnity applies where the quantum of loss can be fairly and accurately measured. There is no question of indemnification in the question of life insurance because the loss resulting from the death cannot be estimated in terms of money. Life insurance contract is not a contract of indemnity because the value of human life cannot be measured in terms of money. That is why the amount payable in life insurance on the happening of the event is fixed at the time of entering into the contract. Now we will understand the types of life insurance policies. When the proposal form is filled by the insured or the proposer and the insurance company accepts the same and the premium and a policy is issued to the insured. People have different requirements and so they would like a policy to fulfill all their needs. Therefore, to meet the different needs of people, insurers have developed certain different types of insurance policies. Some of the insurance policies are described below. First is whole life policy. A whole life insurance policy provides lifetime coverage until the death of the life assured. In this policy, the premium is payable for a fixed period, say 20 or 30 years, or for the whole life of the assured. The sum assured is paid to the nominee when the life assured dies. Second is endowment life insurance policy. The endowment policy is a life insurance contract which is designed to pay a specified sum after a specific term on its maturity or on death, whichever is earlier. In the case of death of the assured, the sum is payable to the nominee or legal heirs. Otherwise, the sum will be paid to the assured after a fixed period, that is, when he or she attains a particular age. Third is joint life policy. This policy is taken by two or more persons. The premium is paid jointly or by either of them in installments or in lump sum. The assured sum or policy money is payable upon the death of any one person to the other survivor or survivors. Usually, this policy is taken up by the husband and wife jointly or by two partners in a partnership firm, where the amount is payable to the survivor on the death of either of the two. Now, the fourth policy is annuity policy. Under this policy, the premium is paid in installments over a certain period, or single premium may be paid by the assured. When the assured attains a certain age, the assured sum or policy money is payable in monthly, quarterly, half yearly, or annual installments. This type of policy is useful to those who prefer a regular income after a certain age. Now, fifth policy is children's endowment policy. This policy is taken by a person for his or her children to meet the expenses of their education or marriage. The agreement states that when the child attains a particular age, a certain sum will be paid by the insurer. The premium is paid by the person entering into the contract. A child endowment policy plan is unique as it has a clause that if he, that is parent, dies before the maturity of the policy, no premium will be paid. If you like our video, please like, share and subscribe our channel. Thank you.